Let me tell you about a phone call I received in 2008 that changed how I think about protecting wealth forever. It was a Saturday morning in October, right in the middle of the worst financial crisis since the Great Depression. Markets were in free fall, banks were collapsing, and I got a call from an old friend of mine, a man who had worked his entire life as an engineer, saved diligently for 40 years, and had just retired 18 months earlier with what he thought was a bulletproof portfolio. He was crying, 71 years old, and he was crying on the phone because he had just watched his retirement savings drop by 43% in less than a year. He told me he might have to go back to work. He told me he could not sleep at night. He told me his wife was terrified they would lose their home. And here is what broke my heart. His portfolio was not filled with speculative garbage. He owned blue-chip stocks. He owned bonds. He owned what every financial advisor had told him was a conservative, diversified portfolio. And it still got crushed because the conventional wisdom about retirement portfolios is dangerously incomplete. That conversation haunted me for years, and it drove me to think deeply about what it really means to build a portfolio that can survive any storm. Not just the average storms, not just the typical 10 or 15% corrections that happen every few years, but the real storms. The once-in-a-generation catastrophes that wipe out decades of savings for people who cannot afford to start over. If you are over 65, you do not have the luxury of waiting for recovery. You do not have 20 or 30 years to ride out a major decline. You need income. Now you need stability. Now you need a portfolio that will not force you to sell at the worst possible time just to pay your bills. Today I am going to share with you the exact framework I have developed over 4 decades in banking and finance for building what I call a storm-proof portfolio. This is not about maximizing returns. This is not about getting rich. This is about making sure you never have to make that phone call to someone crying because everything you worked for has evaporated. Before I get into the specific allocation, let me explain why most retirement portfolios fail when they are needed most. Because if you do not understand the problem, you cannot appreciate the solution. The traditional advice for retirees is something called the 60-40 portfolio, 60% stocks, 40% bonds. The idea is simple. Stocks provide growth, bonds provide stability, and together they balance each other out. When stocks go down, bonds go up. When stocks go up, you get growth. It sounds perfect in theory. But here is what the financial industry does not tell you. The 60-40 portfolio has failed catastrophically in every major crisis of the past 50 years. In 2008, bonds did provide some cushion, but the stock portion fell so dramatically that retirees still lost 5% of their total portfolio in 2022. Something even worse happened. Both stocks and bonds fell at the same time. The supposed diversification benefit completely disappeared. Retirees following the 60-40 model lost 20% or more in a single year. And this is not ancient history. This is happening right now. The fundamental assumptions behind the 60-40 portfolio that stocks and bonds move in opposite directions, that bonds are always safe, that diversification always works. These assumptions are being challenged by the economic realities of the modern world. We live in an era of unprecedented government debt, of inflation that can spike without warning, of interest rate volatility that can destroy bond portfolios overnight. The old rules do not apply anymore, and if you are still following the old rules, you are taking risks that you probably do not even understand. So let me tell you what actually works. Let me share the framework that I believe gives retirees the best chance of surviving whatever the economy throws at them, the foundation of a storm. Proof portfolio is what I call the bucket strategy. This is not a new concept, but most people implement it incorrectly. Let me explain how to do it right. Imagine your retirement savings divided into 3 separate buckets. Each bucket has a different purpose, a different time horizon, and a different investment approach. The key is that you never have to touch the wrong bucket at the wrong time. Bucket 1 is your cash reserve. This is money that you will need in the next 1 to 2 years. This is not invested in anything. It sits in high-yield savings accounts, money market funds, or short-term treasury bills. Right now, you can get 4.5% to 5% on this money with essentially zero risk. This bucket should contain enough to cover 2 full years of living expenses beyond what Social Security and any pensions provide. Let me be specific. If you need $60,000 per year to live on, and Social Security provides $30,000, then you need $30,000 per year from your portfolio. That means bucket 1 should contain $60,000, covering 2 years of that gap. Why 2 years? Because in the worst market crashes, it typically takes about 18 to 24 months for stocks to recover, at least partially from their lows. By having 2 years of cash, you never have to sell stocks when they are down. You can wait for recovery. Bucket 2 is your income bucket. This is money you will need in years 3 through 7. This bucket should be invested in income, generating assets that are more stable than stocks, but offer better returns than cash. We are talking about short and intermediate term bonds, dividend, paying utility stocks, real estate investment trusts focused on essential properties, and preferred stocks from solid companies. The goal of Bucket 2 is to generate 4 to 6% annual returns with low volatility. You are not trying to get rich here. You are trying to create reliable income that you can tap into once Bucket 1 is depleted. And as you spend from Bucket 1, you periodically refill it by moving money from Bucket 2. Bucket 3 is your growth bucket. This is money you will not need for at least 7 years. And because you have a 7-year time horizon, you can afford to invest this money more aggressively. This is where your stocks go, your equity investments, your exposure to long-term growth. But here is the crucial insight that most people miss. Even Bucket 3 should not be invested the same way a 30-year. Old invests, you need to focus on quality, on stability, on companies that can survive and even thrive during economic disasters. Let me walk you through each bucket in more detail, because the specific investments matter enormously. For Bucket 1, your cash reserve, the goal is maximum safety and liquidity. Right now, Treasury bills are your best friend. You can buy 4-week, 8-week, or 13-week Treasury bills directly from the government through Treasury Direct, and they are paying close to 5%. This is essentially risk-free money. The United States government will not default on Treasury bills. Money market funds are another excellent option, particularly those that invest in government securities. Look for funds with expense ratios below 0.2%. Vanguard and Fidelity both offer excellent options. The key is to avoid reaching for yield in Bucket 1. You might see some money market funds or short-term bond funds offering slightly higher returns, but they come with risks that have no place in your cash reserve. I have seen people put their emergency cash in high-yield bond funds because they pay 6 or 7% instead of 5%. And then when a crisis hits, those funds drop 15%, and suddenly your emergency cash is not there when you need it. Do not make this mistake. Bucket 1 is for safety. Period. For Bucket 2, your income bucket. We need to be more sophisticated. This is where you generate the reliable income that will fund your retirement for years 3 through 7. Let me share the specific allocation that I believe works best. First, about 30% of Bucket 2 should be in short-term investment-grade corporate bonds. These are bonds from solid companies with maturities of 1 to 3 years. The short maturities protect you from interest rate risk. If rates rise, Your bonds mature quickly, and you can reinvest at higher rates. If rates fall, you still collected your interest payments. Look for ETFs or mutual funds that focus on short-term corporate bonds with an average credit rating of A or higher. Second, about 25% should be in Treasury inflation-protected securities, known as TIPS. These are bonds issued by the federal government that automatically adjust for inflation. If inflation spikes, your principal increases. This is crucial protection that most retirement portfolios lack entirely. The past few years have shown us that inflation can appear suddenly and devastatingly. People who retired in 2020 with what they thought was enough money found that inflation eroded their purchasing power by 20% or more over the following 3 years. TIPS provide insurance against this exact scenario. Third, about 20% should be in dividend aristocrats. These are companies that have increased their dividends every year for at least 25 consecutive years. We are talking about companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, and similar stalwarts. These companies have survived world wars, depressions, recessions, pandemics, and every other disaster the economy has thrown at them, and through it all, they kept paying and increasing their dividends. The dividend income from these companies is remarkably stable. Even in 2008, most dividend aristocrats maintained their payouts. That means even when stock prices fell, retirees still received their quarterly dividend checks. Fourth, about 15% should be in utility stocks. Utilities are boring, and that is exactly what we want. People need electricity regardless of what the economy is doing. They need natural gas for heating. They need water. Utility companies provide essential services with regulated returns, which means their earnings are predictable and their dividends are reliable. The best utility stocks yield between 3 and 5% currently, and they tend to hold up much better than the overall market during crashes. In 2008, while the S&P 500 fell 57% from peak to trough, the utility sector fell only about 40%. That is still painful, but significantly less devastating. Fifth, the remaining 10% of bucket 2 should be in real estate investment trusts, or REITs, focused on essential properties. I am not talking about office buildings or shopping malls. I am talking about healthcare facilities, data centers, cell phone towers, and warehouse distribution centers. These types of properties benefit from long-term trends that are unlikely to reverse. Healthcare REITs own nursing homes, medical office buildings, and hospitals. The aging population guarantees demand for these facilities for decades. Data center REITs own the facilities that house the servers powering the internet and cloud computing. This demand is only growing. Cell tower REITs own the infrastructure that enables mobile communication as long as people use smartphones. These assets generate income. Now let me talk about bucket 3, your growth bucket. This is where most people make their biggest mistakes. They either invest too conservatively and fail to keep up with inflation over the long term, or they invest too aggressively and suffer catastrophic losses when markets crash. The key to bucket 3 is quality. I cannot emphasize this enough. When you are over 65, you cannot afford to speculate. You cannot afford to chase the latest hot stock or sector. You need to own businesses that will be more valuable in 10 years than they are today, and that can survive economic disasters along the way. Let me tell you what I look for in bucket 3 investments. First, I want companies with strong balance sheets. That means low debt relative to their equity and cash flows. Companies with too much debt are vulnerable when times get tough. They have to keep making interest payments even when their revenues decline. They cannot invest in their business because all their cash goes to creditors, and in the worst cases, they go bankrupt and shareholders lose everything. In 2008, the companies that survived and thrived were the ones with strong balance sheets. They could weather the storm, continue operating, and even acquire distressed competitors at bargain prices. The overleveraged companies collapse. Second, I want companies with durable competitive advantages. Warren Buffett calls this a moat. It is something that protects the business from competition, that allows it to earn high returns on capital year after year. This could be a powerful brand, a network effect, economies of scale, or regulatory barriers that make it hard for new competitors to enter. Think about a company like Apple. Once someone is in the Apple ecosystem with an iPhone, a MacBook, AirPods, and an Apple Watch, they are unlikely to switch to Android. Everything works together seamlessly. That is a competitive advantage that protects Apple's profits even during recessions. Third, I want companies with pricing power. This means they can raise prices without losing customers. In an inflationary environment, this is essential. Companies without pricing power see their costs rise while their revenues stagnate. Their profits get squeezed. But companies with pricing power can pass cost increases along to customers, protecting their margins. Fourth, I want companies that generate lots of free cash flow. Free cash flow is the money left over after a company pays all its bills and invests in maintaining its business. This cash can be used to pay dividends, buy back shares, pay down debt, or invest in growth. Companies with strong free cash flow can self-fund their operations without relying on fickle capital markets. So what specific investments meet these criteria for Bucket 3? I believe the core of Bucket 3 should be a low-cost S&P 500 index fund. Despite all the market volatility, despite all the crashes, the S&P 500 has delivered roughly 10% annual returns over the past century. No other asset class comes close over long periods. But here's the key insight. I would only put about 50% of Bucket 3 in a broad index fund. The other 50% should be in specific sectors and companies that I believe offer better risk. Adjusted returns for retirees. About 20% of Bucket 3 should be in healthcare stocks. The demographics are undeniable. The population is aging. Baby boomers are entering their 70s and 80s. Healthcare spending always increases with age. Whether the economy is booming or in recession, people need their medications, their surgeries, their medical care. The largest healthcare companies, the pharmaceutical giants, the medical device manufacturers, the health insurers, these are businesses with strong competitive positions and reliable demand, and many of them pay solid dividends, adding an income component to your growth bucket. About 15% of Bucket 3 should be in consumer staples. These are companies that sell products people buy regardless of economic conditions. Toilet paper, toothpaste, food, beverages, cleaning supplies. Nobody stops buying these things because the stock market crashed. Consumer staples companies like Procter & Gamble, Colgate, Palmolive, and PepsiCo have weathered every recession in modern history. They may not grow as fast as technology companies during boom times, but they do not collapse during busts either. For a retiree, that stability is worth its weight in gold. About 10% of Bucket 3 should be in what I call quality technology. I am not talking about speculative startups or unprofitable tech companies. I am talking about the dominant platforms that are essential to modern life and commerce. Microsoft is a perfect example. Businesses around the world run on Microsoft software. The shift to cloud computing through Azure is a multi-decade growth driver. The company generates enormous free cash flow and has raised its dividend for many years. This is not speculation. This is owning a piece of essential digital infrastructure. The remaining 5% of Bucket 3 can be in international developed market stocks, providing some geographic diversification. Focus on countries with stable governments, strong legal systems, and established markets. Think Western Europe, Japan, and Australia. not emerging markets that add volatility without reliable compensation. Now let me talk about what to avoid in your storm-proof portfolio, because knowing what not to own is just as important as knowing what to own. First, avoid long-term bonds. I know this sounds counterintuitive. Bonds are supposed to be safe, right? But long-term bonds, those with maturities of 20 or 30 years, are actually quite risky in the current environment. Here is why, when interest rates rise, bond prices fall, and the longer the maturity, the more the price falls. In 2022, long-term Treasury bonds lost nearly 40% of their value as interest rates spiked. 40%, that is stock market crash territory from supposedly safe government bonds. With government debt at record levels and inflation remaining unpredictable, I believe long-term interest rates are more likely to rise than fall over the coming decades. Then long-term bonds a poor bet for retirees seeking stability. Second, avoid high-yield bonds, also known as junk bonds. Yes, they pay higher interest rates. That is because they are issued by companies that are more likely to default. In every recession, junk bond default rates spike. Investors who reach for that extra 2 or 3% in yield end up losing 15 or 20% of their principal. The extra yield from junk bonds is not free money. It is compensation for real risk. And for retirees who cannot afford major losses, that risk is not worth taking. Third, avoid speculative stocks of any kind. No cryptocurrency, no meme stocks, no money, losing technology companies that might be the next big thing. No penny stocks, no biotech companies betting everything on one drug approval. I do not care how compelling the story sounds. I do not care if your neighbor made a fortune. These investments are gambling, not investing, and gambling with your retirement savings is reckless. Fourth, avoid concentrated positions. I have seen too many retirees with 50 or 60% of their wealth in a single company's stock, often because they worked there for decades and accumulated shares through employee stock purchase plans. This is incredibly dangerous. Enron employees had their retirement savings wiped out when the company collapsed. So did employees of WorldCom, Lehman Brothers, and countless other companies that seemed invincible until they were not. No matter how much you believe in a company, no matter how well you know it, you should never have more than 5% of your portfolio in any single stock. Diversification is your protection against the unexpected. Fifth, avoid market timing. Do not try to sell before crashes and buy back at the bottom. It sounds great in theory, but it does not work in practice. Professional investors with unlimited resources and sophisticated tools cannot consistently time the market. You cannot either. The real danger of market timing is not just missing the best days. It is the emotional toll it takes and the bad decisions it leads to. People who try to time the market typically sell after crashes, when prices are low, and buy back after recoveries. When prices are high, they systematically buy high and sell low, the exact opposite of what builds wealth. The storm-proof portfolio I have described works precisely because you do not have to time the market. The bucket structure means you always have cash available when you need it, regardless of what stocks are doing. You can simply wait out the storms. Let me now talk about how to actually implement this portfolio, because theory is useless without practical execution. If you are starting from scratch, the first step is to calculate your annual spending needs beyond Social Security and pensions. Be honest and thorough. Include everything: housing, food, transportation, healthcare, insurance, travel, entertainment, gifts, and a cushion for unexpected expenses. Once you have that number, multiply it by 2. That is how much goes into bucket 1, your cash reserve. Next, Multiply your annual spending needs by 5. That is approximately how much should go into bucket 2, your income bucket. This provides years 3 through 7 of spending. Whatever is left goes into bucket 3, your growth bucket. If this calculation leaves you with very little in bucket 3, that is actually fine. It means your priority should be stability and income. Not growth. You have enough to fund your retirement, and your job now is to protect it, not grow it. If the calculation shows you do not have enough to fund even 7 years of spending, you have a different problem. You may need to reduce expenses, work longer, or consider part-time work in retirement. No investment strategy can make up for simply not having saved enough. For most people reading this, though, the bucket strategy will provide both the security of knowing you can survive any market storm and the growth potential to keep up with inflation over the long term. Let me share some additional principles that will help you maintain your storm-proof portfolio over time. First, rebalance annually. Once a year, look at your 3 buckets and make sure they still align with your target allocation. If stocks have done well, bucket 3 will have grown. Take some of those gains and move them to buckets 1 and 2. If stocks have done poorly, buckets 1 and 2 will be relatively larger. That is fine. You do not need to add to stocks when they are down if it makes you uncomfortable. The key is to never let bucket 1 get depleted without refilling it from bucket 2, and never let bucket 2 get depleted without refilling it from bucket 3. This systematic approach removes emotion from the equation. Second, take your required minimum distributions strategically. Once you reach the age where you must take money from traditional retirement accounts, think carefully about which bucket to draw from. Generally, you want to take RMDs from bucket 3, your growth bucket, because those withdrawals create an opportunity to rebalance third. Consider Roth conversions if you have room in your tax bracket. Converting traditional IRA money to Roth IRA money means paying taxes now, but never paying taxes on that money again. For retirees in lower tax brackets during their early retirement years, this can be a powerful strategy to reduce lifetime taxes. Fourth, keep your costs low. Every dollar you pay in fees is a dollar that is not compounding for your benefit. Use low-cost index funds and ETFs whenever possible. Avoid actively managed funds with high expense ratios. Question any advisor who charges more than 1% of assets annually. Over a 20-year retirement, the difference between paying 0.1% in fees versus 1% in fees could easily amount to hundreds of thousands of dollars. That is real money that should be in your pocket. Not Wall Street's fifth. Do not watch the markets obsessively. You check your portfolio quarterly at most. Watching daily fluctuations serves no purpose except to increase anxiety. Your storm-proof portfolio is designed to work over years and decades, not days and weeks. 6. Have a plan for cognitive decline. This is something nobody wants to talk about, but it is essential. As we age, our ability to manage complex financial decisions often diminishes. Make sure you have trusted family members or advisors who can step in if needed. Consider simplifying your portfolio as you get into your late 70s and 80s. Consolidate accounts. Automate what can be automated. Let me tell you about what happened to my friend, the one who called me crying in 2008. After that crisis, we sat down together and restructured his portfolio using the principles I have shared with you today. We built a 3-bucket structure. We focused on quality and income. We eliminated speculation and reduced his stock allocation to a level that let him sleep at night. In the years since, his portfolio has not grown as fast as the overall market during boom times. But it also did not collapse during the COVID crash of 2020. It did not get hurt badly during the 2022 bond and stock sell-off. He has been able to fund his retirement, travel with his wife, spoil his grandchildren, and live without financial anxiety. He is 88 years old now, and he recently told me that the peace of mind from knowing his portfolio can survive any storm has added years to his life. The stress of worrying about money, the fear of another 2008, that is gone. He knows he will be fine no matter what the markets do. That is what a storm-proof portfolio provides. Not maximum returns, not bragging rights at cocktail parties, but something far more valuable, the freedom to enjoy your retirement without financial fear. If you are over 65, you have worked hard your entire life. You have saved and sacrificed. You deserve to enjoy the fruits of that labor without worrying that the next market crash will take it all away. Build your 3 buckets, focus on quality, avoid speculation, keep your costs low, and most importantly, stop trying to beat the market. Your goal now is not to get rich. Your goal is to stay rich, to protect what you have, and to make it last as long as you need it to. The storms will come, they always do, but with the right portfolio structure, you will not just survive them. You will barely notice them. And that is exactly how your retirement should be. Now, let me address some questions I frequently hear from retirees about this approach. The first question is always about Social Security. When should you take it? This is crucial because Social Security forms the foundation of most retirement plans, and getting it right can mean tens of thousands of dollars over your lifetime. My view is that most people should delay Social Security as long as possible, ideally until age 70. Every year you delay past your full retirement age, your benefit increases by 8%. That is guaranteed. You cannot get a guaranteed 8% return anywhere else in this environment. Think about what that means if your benefit at 67 is $2,000 per month. Waiting until 70 increases it to $2,480 per month. That is an extra $5,760 per year for the rest of your life, adjusted for inflation. The math overwhelmingly favors delaying for most people. Yes, you give up 3 years of payments, but if you live past your early 80s, and most people do, you come out way ahead by waiting, and you have reduced longevity risk, the risk of outliving your money, which is the biggest threat retirees face. Of course, this assumes you have other resources to live on during those years of delay. That is where your storm-proof portfolio comes in. Your buckets provide the income you need while you let Social Security grow. The second question I hear is about healthcare costs. This is the great unknown in retirement planning, and it terrifies people for good reason. A serious illness can burn through savings faster than any market crash. My advice is to be very conservative in estimating healthcare costs. The average 65-year-old couple will spend over $300,000 on healthcare during retirement, not including long-term care. And that is an average, which means half will spend more. Make sure your budget includes substantial healthcare costs. Consider a health savings account if you are still eligible, as it offers triple tax advantages. And think seriously about long-term care insurance, especially if you have a family history of dementia or other conditions requiring extended care. Long-term care is the wild card that can destroy even the best retirement plan. A year in a nursing home costs over $100,000 in most states. 3 or 4 years of care can wipe out a lifetime of savings. Long-term care insurance is expensive, and I understand why people are reluctant to buy it. But for many retirees, especially those with assets to protect and no adult children who can provide care, it is worth serious consideration. The peace of mind alone has value. The third question is about leaving money to heirs. Many retirees want to leave something to their children or grandchildren, and they wonder how to balance this goal with their own need for security. My answer is always the same. Put your own oxygen mask on first. You cannot help your children from a position of financial weakness, and nothing is worse for adult children than having to support aging parents who ran out of money because they prioritized inheritance over their own security. That said, if your stormproof portfolio is large enough that you are unlikely to deplete it during your lifetime, there are strategies to maximize what you leave behind. Roth conversions, as I mentioned, mean your heirs inherit tax-free money. Keeping taxable accounts invested in equities that get a step up in basis at death can eliminate capital gains taxes entirely. But these are secondary considerations. First priority is always making sure you never become a burden on your family or run out of money yourself. The fourth question is about withdrawal rates. How much can you safely take from your portfolio each year without running out of money? The traditional answer is 4%. Adjusted for inflation, this is based on historical research showing that a 60-40 portfolio could sustain 4% withdrawals over any 30-year period in history. But I am more cautious than that for several reasons. First, we are living longer than previous generations. Your retirement might last 35 or 40 years, not 30 seconds. Valuations today are higher than historical averages, which typically means lower future returns. Third, the 60-40 portfolio has structural issues I have already discussed. For most retirees using the storm-proof portfolio I have described, I suggest starting with a 3 to 3.5% withdrawal rate. This is more conservative, but it provides a much larger margin of safety. If your portfolio grows and you reach your late 70s or 80s still flush with cash, you can always spend more then, but you cannot recover from depleting your portfolio too early. The fifth question is about annuities. Should you buy an annuity to guarantee lifetime income? This is a complicated topic, but here is my general view. A simple, immediate annuity where you give an insurance company a lump sum and they pay you a fixed amount every month for life can make sense for a portion of your portfolio. It provides guaranteed income that you cannot outlive, which reduces longevity risk. However, I would be very cautious about complex annuity products, especially variable annuities with multiple riders and fees. The fees on these products are often atrocious, eating away at your returns year after year, and the complexity makes it hard to understand what you are actually getting. If you consider an annuity, keep it simple. Use only a portion of your portfolio, perhaps covering your essential expenses minus Social Security, and stick with highly rated insurance companies that will still be around decades from now. Let me also talk about some common mistakes I see retirees make beyond the ones I have already mentioned. The first mistake is keeping too much in cash because of fear. I understand the instinct. After living through a market crash, the idea of putting money at risk is terrifying, but too much cash is its own risk. Inflation erodes purchasing power year after year. $1 million in cash today will buy far less in 20 years. You need some growth to maintain your standard of living. The storm-proof portfolio I have described provides that balance. You have enough cash for security, but enough invested for growth. Do not let fear push you too far toward cash. The second mistake is chasing yield. Interest rates are higher now than they have been in years, and that is great. But some retirees see advertisements for investments yielding 8 or 10% and think they have found the answer to their prayers. Be very suspicious of anything yielding much more than treasury rates. That extra yield is compensation for risk. It might be credit risk, meaning the borrower could default. It might be liquidity risk, meaning you cannot sell easily when you need to. It might be structural risk, meaning there is something complicated about the investment that you do not understand. In finance, there is no free lunch. Higher yield always means higher risk, and the investments pitched most aggressively to retirees, things like non-traded REITs, business development companies, and structured products often have the highest fees and worst risk-reward profiles. Stick with simple, transparent, low-cost investments. You do not need to be clever. You need to be careful. The third mistake is failing to plan for taxes. Many retirees have most of their savings in tax-deferred accounts like traditional IRAs and 401k plans. Every dollar you withdraw from these accounts is taxed as ordinary income. With thoughtful planning, you can minimize your lifetime tax burden. This might mean taking more income in low tax years to reduce future required minimum distributions. It might mean strategic Roth conversions. It might mean being thoughtful about which accounts you withdraw from and in what order. This is an area where working with a qualified tax professional can pay for itself many times over. The tax code is complex, and there are opportunities that most people miss. The fourth mistake is ignoring estate planning. This is not just for the wealthy. Everyone needs basic documents: a will, a power of attorney, healthcare directives, and beneficiary designations on all accounts. I have seen families torn apart by inadequate estate planning. I have seen situations where a spouse could not access accounts because the other spouse became incapacitated and no power of attorney existed. I have seen retirement accounts go through probate because beneficiary designations were never updated after a divorce take. Care of this paperwork. It is not pleasant to think about, but it is one of the most important things you can do for your family. The fifth mistake is not adjusting the plan over time. Retirement is not static. Your needs change, your health changes, tax laws change, economic conditions change. Review your storm-proof portfolio at least annually. Make sure your assumptions are still valid. Adjust if needed. Stay engaged with your finances even if you have help from professionals. Let me close by returning to where I started, to my friend who called me crying during the 2008 crisis. That moment crystallized something for me that I had understood intellectually but had not felt emotionally for people who have spent their lives working and saving. Their portfolio is not just money. It is the physical manifestation of decades of effort, sacrifice, and discipline. It represents every extra shift worked, every vacation not taken, every luxury forgone. When that portfolio collapses, it feels like all that work meant nothing. It feels like a betrayal. It is devastating in a way that people who have not experienced it cannot fully understand. The storm-proof portfolio I have shared with you today is designed to prevent that devastation, not to make you rich, not to beat the market, but to ensure that you never have to experience the terror of watching your life's work evaporate while knowing you are too old to earn it back. You have earned the right to enjoy your retirement. You have earned the right to sleep peacefully at night. You have earned the right to know that no matter what happens in the markets, in the economy, in the world, you will be okay. Build your storm-proof portfolio. Protect what you have worked so hard to accumulate, and then go live your life free from financial fear. That is the gift you deserve, and that is exactly what the right portfolio can provide.